Hey, what's good, everybody? It's your boy TBT, aka the Brainless Trader, and we back with another video. Today, I just want to go over something that I feel like is very important for y'all to consider and talk about. Um, I would like to talk about the one strategy that ICT uses to make sure that he stays out of making too many trades in the market during the week. So this is essentially how he determines when and where he will stop. Um, and the first thing that he really does, and he's taught us to do, is in the beginning of the week, you should be looking for what is the outlook, what is the weekly target, right, from the weekly chart for the pairs that you're trading, right? Typically he starts with the JXY and then just tries to understand where he believes the weekly uh, candlestick is going to print, right? And so if you're looking at this, we're looking at GBP USD, and just looking at this chart alone, we knew that this week we had already come off of a run on liquidity, right? There was a run on liquidity here and here, and we already had one bearish candle, two bearish candles. So this is the candle for this week, right? Um, so we wanted to know what was going to allow us to be able to tell where we're going to end the week or potentially go during the week, right? Um, and so there's a lot of different strategies that he kind of points to as far as, inside days, outside days, what to expect after a certain type of candlestick. But none of that is what I'm referring to here. Currently, what I'm referring to is simply the weekly output. So understanding, where price might start the week off, and then from there understanding where it might want to go, right? So if we go back down to the daily and we try to see, okay, where did this week start? We most likely started here. This is Monday, and we knew that already you had liquidity to the bottom side, right? You had already ran off liquidity to the upside, to the buy side, and on the sell side you had some nice liquidity, some relative equal lows that are already close to where you're starting the week off. So just right there and there, this is the beginning of understanding, okay, I know where my potential targets are. If I know where my potential targets are, now I have to line up the PD arrays, right? The PD arrays that ICT talks about, all of the things that he uses to help people get into trades. Now I'm going to use these to help align what I'm thinking price is going to go to. And after the price gets to that target, that's when I know how to stop. So that's the key to understanding this strategy, right? Is you're looking basically at the weekly candle. You're trying to determine based off of what price is giving you, the feedback price is giving you, how do I know where I should stop making trades for the week? You will know based off of where liquidity is and where price wants to go. If you can understand where price wants to go, then you can understand where you want to go as far as making your trades, entering your trades, right? You will frame your entire setup for the entire week, right? Where your trades want to be. And then from there, you can say, okay, I'm targeting this area. If price continues to align PD arrays, align signals within the market, along with the news and things like that, that are going to continue towards this target. Once I hit this target, boom, I'm done. I'm done for the week. So I'm going to illustrate to you now. Once you know the weekly outlook based off of the candlesticks and based off of where liquidity is, I'm going to show you how you can then get into the trades. And once you get into those trades and you've actually, superseded where that liquidity was that you were looking at, then you can stop, right? And so the bottom line up front is you want to be thinking with a humble brain, humble mindset, right? A lot of times I like to talk about psychology, basically, because a lot of times that psychology can help you align exactly where you want to be during the week and where you're trading and keep your mindset correct, right? So a lot of what I do is using what ICT has taught here, determining where price wants to go. And then from there, I can be confident in the trades and the things that I'm trying to set up for myself, knowing that at some point, whenever price does, if it does reach this level of liquidity, I'm going to stop. Like I'm going to be done, right? Okay. So now we can start breaking it down to further time frames, right? I basically go from the weekly to the day. I use every single one of these time frames aside from the 1 minute. I use the 3, the 5 minute, and the 15 when I'm actually entering trades. But I frame my trades off of the setups that are formed in the daily the weekly, the daily, the 4 hour, 2 hour. Um, so let's start there. If you're looking, you already know that there's a breaker here. High, low, higher high, lowest two down closed candles, breaker. Fair value gap across from it. This is the breaker zone here, and you see price trades up into that. If this was the high of the breaker zone here, and price trades up into that, and then up into the fair value gap at the same time. So boom, already on Monday and Tuesday, we're like, oh, interesting. And if you zoom in here, we'll get here on the lower time frames as well. But if you zoom in here, you can tell that on Tuesday, price first takes out the buy side liquidity from the previous Friday, and the Monday goes into the fair value gap that was created on the previous Thursday, and also into the breaker, correct? Okay, so this is just a higher time frame outlook. You already know this based off of Monday and Tuesday, but on Tuesday, really that's where you want to be paying attention to, because that run on liquidity happens, and that's when you can potentially start getting into trades. So let's go down to that time frame. Let's go down to probably the hour, and let's see what we got. All right. So let's look at what we had. Oh, we're going way too far. I believe it's right here. All right, so I already outlined that breaker to you. Dang, we going too far. Relax, bruh. All right, right here. So boom, this is the Tuesday, right? Now, these red bands that you see on the chart are how I determine where my Asian range is. And the reason why I want to know where my Asian range is because my Asian range will tell me each day, one, where stops are that we can run past to then activate into new trades. But in general, a lot of times the chart will use the Asian range to then prepare itself for more trades, right? And specifically the 12 a.m. open within that Asian range. ICT calls it the New York 12 a.m. open, New York session 12 a.m. open is what he calls it. But essentially, it's just 12 a.m. each day. That anchoring point a lot of times is where ICT will use to then say, if I'm bearish at that 12 a.m. open, let's just say right here, where's that 12 a.m. open? Right here. Here's my line for 12 a.m. open. Once price goes above that 12 a.m. open into a PD array around liquidity, fair value gap, now I'm looking for trades continuing in the direction that I want, right? In the sell side. Okay, so now let's break down the actual things on the chart that you could use, right? If we go down to the 30-minute, and let me make sure my executions are on the chart too, so y'all can see exactly how I use this strategy during the week. All right, cool. Where they at? Oh, looks like I'm gonna have to turn on paper trading. Is it on? Yeah, it's on. All right. Where are my executions though? These executions be funny. Anyways, now looking at this, you see what I just outlined. There was buy side liquidity into a fair value gap. Boom. You ran those stops at 5 a.m. and then you begin to make moves to the bottom side. What times are the Asian range? So the Asian range, we're looking at basically, let's see. I gotta go into my notes for that one. The Asian range. Oh, actually, we can just use this. The Asian range, we're going from 1900, which 1900 is what? 7 o'clock? 7 o'clock New York time, all the way to 4 a.m. New York time. So there's your Asian range. 7 o'clock New York time to 4 a.m. New York time. Now, 1900, yeah, that's correct. Now, ICT's focus point within the Asian range, he likes to look at that first half. So that's 7 a.m. to 12 a.m. That price action, he uses that 12 a.m. anchoring point in this strategy, right? It's basically his Asian range. I wouldn't call it. I call it the Asian range sniper because it's very accurate. But is basically his Asian range strategy, where you have a run on liquidity against the higher time frame bias into a PD array. And this is actually what he talked about. If you look at his most recent video on order flow, he gives 2 or 3 examples where price runs liquidity and then creates breakers, and then those breakers, he uses those breakers to enter into trades. All right, let's keep going. And what's up, my boy? Hope you're doing well, man. So boom, if I can get my executions on the chart, and I can show you where I answered, hopefully. Come on, executions. Come on in. Where y'all at? I must not enter down there. Oh, I entered way over here. Okay. So this is an example of what you could have done, right? But now, where I actually entered, I'll break down what I actually did. Okay. Here we go. So now, knowing that we're already bearish for the week, right? We get into, oh no, this is Tuesday. Okay, thank you. All of this. Oh, this was way before. All right. No. Yeah, this is this week. So knowing where you're at, right, in the market, you've got that same setup. First, look for your Asian range 12 a.m. open, right? So let's tabulate that. If we're looking on this day, on May 23rd, where I actually entered trades, the 12 a.m. open was here, this candlestick. And let's zoom in so you can have a clear outlook. May have to, give us a little bit of context here. Okay, cool. So this is the 12 a.m. open. Let's change my color to purple because I like my 12 a.m. open to be purple. All right. And give me a solid line because I don't like that dotted line for this. Label it 12 a.m. open. Give it to me. Oh, there you go. Okay. Now you got your 12 a.m. open. Now you're looking for a run on liquidity against the higher time frame bias, which is overly bearish. Okay. You're looking for a run on liquidity into what? A PD array. So let's say a fair value gap. It could be an order block. It could be a fair value gap and an order block. It could be a breaker. It could be anything. Okay. You just want to see how price is going to respond to that PD array. All right. So let's look and see how price responds to this one. On the hourly chart, we have an hourly fair value gap. Not only do we have that, but I don't have tabulated on my chart this hourly order block. Highest up close candle. Now we put this highest up close candle in my colors that I like to have, orange, and make the line a little bit less thick. I believe that line was down here. And then let's just move this back. Okay. Boom. So you have a combination of an order block, a fair value gap, and a run on liquidity. You have these stops here that you ran out earlier in the morning, and then you run out these relatively equal highs into the fair value gap. Now you want to know where is price going to finish within this fair value gap. You know, ICT likes to talk about the consequential encroachment, correct? So we're looking at the midpoint of this fair value gap. You want to see where exactly on the midpoint is price going to finish. Is it going to finish right in the middle, just above the midpoint? And wherever it finishes, regardless, you really just want it to finish within the fair value gap and then give you some impulsive movement away from the fair value gap, regardless of where it finishes in the fair value gap, so long as it doesn't finish above the fair value gap. When I say finish, I mean close, so long as the candle doesn't close above the fair value gap, right? And keeping this all in the mind frame of the fact that we want to know where that target was, right? So if we go back to our weekly target, we want to make sure that we understand where is our weekly target, because that's how we're going to know when to stop for the week, right? So long as we haven't reached that weekly target, that's how we'll know, what we're doing. So let's see, where is that weekly target? Let's make sure we have that on the chart. Uh-oh. Let's see. Oh, there it is. All right. So our weekly target is here. This is, let me just label it as the weekly target. Oh, no, that's way far. I was not talking about that target. I was talking about this target up here. Yeah. So you got this target, and this target. We're gonna leave that, but this is what I labeled as that weekly target. All right. So within this, understanding that this is the weekly potential target, right? As well as sell side liquidity, this would be our stopping point for the week. If we got this, this would be our stopping point. And you already know that you've got this, right? So earlier in the video, I said this was, but I didn't realize that we were a week ahead. So this was my weekly target, my hope, right? And then I've also got the fair value gap. Let's go into that. If we go on the hour, I believe there's a fair value gap over here that we can look at to say, okay, I outlined it as something that if price gets to it, this is where you would potentially take your profits or look to be safe and stop just because you don't know what price is going to do next. All right. Give me that. And my thing's still moving. Golly. All right. Boom. So if we zoom in here, we have a nice hourly fair value gap. Oh, slow it down. All right. Boom. So you got the potential weekly target. You got the potential fair value gap on the hourly that you're looking for a price to potentially reach. Now, if it reaches it, you have to be disciplined and take your profits, because if it reaches it, that means that it's your stopping point. If price goes above or below your target, it's possible, but you should still have in your mind that this is what I need. This is what I want. I'm not going to be greedy. I'm not going to be upset if it reaches my target and surpasses my target and gets 200 more pips, and I could have been in for 200 more pips. No, you're just trying to get into what you need for the week, your low hanging fruit target. And I think a lot of times that low hanging fruit, us not being able to determine that and come to terms with the fact that that's all we need for the week, that hurts a lot of traders. So that's what you need to understand first and foremost, is your targets, they have to be modest and within reason so that you know when to stop for the week. Okay, so now let's frame the trade again. We had a run on higher time frame liquidity into a fair value gap, into an order block. Okay, cool. Now, what do we need to form? Now, we also know that we're above the 12 a.m. open. If we're bearish, we want to take trades above the 12 a.m. open or right around the 12 a.m. open. So you see where my entries are at, right at the 12 a.m. or above the 12 a.m. open within that fair value gap. And then also right at the 12 a.m. open within the overall framework, right? So if we go down to the lower time frames, we can kind of see how you can be nimble within your entries. All right, let's zoom in. Cool. So we already have the overall framework, and I want to align for you. I'm going to take off these. The lipstick a little bit and just show you from a price action standpoint. Oh, okay. We have a high, low, higher high, ICT breaker, lowest down close candle, reach across from it. What do you have? Fair value gap. Cool. If we go on the lower time frames of 5 minute, that fair value gap will be a little more clear. And like I said earlier, I use the 15, the 5, and the 3 minute to determine where I'm going to get in on my trades. I like to use all three at the same time because it helps me to understand the distance within which fair value gaps that I'm using, and understand where my most safe entry will be, right? Because now from the 15 minute to the 5, you see we have a difference in the fair value gap. This fair value gap is much larger, and then we still have that same area. Matter of fact, we have a lower area, high, low, higher, high, right, for a breaker. We also have this area, high, low, higher, high for a breaker, right? You see that price traded up into the fair value gap across from this breaker, lowest down close candle, fair value gap, that's a breaker, valid. Traded into it. I didn't get into that trade, right? That's at 3 a.m. in the morning. It's within the ICT London kill zone, which is 2 a.m. to 5 a.m. So it could have been a clean entry. As you see, I didn't get in there. I did get in here, right? I got in high, low, higher, high. This is a breaker. Lowest two down close candles. You look across from it. If there's a fair value gap there, it's valid. Price traded up into it once. I said, oh, darn, I already missed that entry. But cool, price traded up into this fair value gap here. There's an order block here. I'm like, okay, this could be a good entry for me. Then what happened? Price moves right against me. I had my stop set above this fair value gap. Price ran me out. So boom, there's a lesson that everything's not going to be perfect, right? You understand that everything's not going to be perfect, but you continue to roll with the punches. Knowing that your ultimate targets are still below, you're still bearish, and here's the first area for a target that you could use, right? Within that overall time frame, we know that we highlighted before where our ultimate target would be, right? But here's some relatively equal lows that we could target, and you'll see that when I re-entered the trade, I re-entered once price touched this fair value gap for the second time. Now ICT talks about with the PD array, if it's entering into a PD array once, twice, okay, it's cool, it's still valid. Three times, that's a no-go. Probably not going to take that trade, right? So you see this is just the second time that price entered into this 5-minute fair value gap, right? Boom, fair value gap. We can outline it for you if you'd like. Mind you, keep in mind what we talked about with the 12 a.m. open. This entry is above the 12 a.m. open, right? So probably one of the safer entries. I'll explain to you what these circles are a little bit later. So boom, I took that trade. Price didn't even go above. I had my stop set above this fair value gap here, but price didn't even go above my entry. And then I went to work, and once I got to my office and sat down, I was like, okay, let's look at the trade. Now, typically, I like to actually watch my trades because I would have taken my profits right here, to be honest with you, if I was watching. But obviously, things happen. You got to be ready for work. You got to get ready for work. Okay, so I actually got to work, and this is the risk that you run doing trading while working and doing all that, because price could have easily ran my entry point, right, and I'd have just been out of the trade. But it was graceful. Pulled into a fair value gap over here. Responded, kept going down. This could have been an additional entry, matter of fact, because you're running out liquidity and pulling into a fair value gap for the second time. Boom, could have had another entry, but nevertheless, it was fine. And then basically once I got to work and realized what was going on, I was like, cool, let me take my money right now. I'm chilling. All right, so that's the first entry. Reframing it within the run on liquidity into a PD array, understanding that we're majorly bearish, understanding that we're using the 12 a.m. open to give us some extra confluence, right? Obviously, on the lower time frames, you're going to see price going above that 1 hour fair value gap. But if you're looking at the hour where the fair value gap was printed, oh, don't want that, then you'll be able to see what exactly happened. Let's go back over. All right, cool. So, spread this out a little bit. That's this entry. Now, we're continuing during the week. How do we know that we want to stop? Okay, we're continuing to get closer to our overall weekly target, right? Remember, I said our overall weekly target was this 1 hour fair value gap and this potential weekly, sell side liquidity here. Now, you see that we have the same exact setup, okay? The same exact setup, all right? And I will explain what these circles are in a minute. Give me a second. The same exact setup that I just explained is forming on the next day. What is the next day, or is it yeah, no, this is Wednesday. Yeah, and then this is Thursday. Sometimes this happens, sometimes it doesn't. You should not expect that you will get the same exact setup, 2 days in a row. You could get the same setup twice a week, maybe on Monday and Thursday, maybe on Tuesday and Wednesday, maybe on Wednesday and Thursday. It's all going to vary, but as long as you know what you're looking for, you will be safe. Okay, you'll be able to make safer entries. Now let's break this one down. Looks like I have the fair value gap on the 30-minute chart. So if we take the lipstick off the chart, let's just explain it. Boom. You saw that when I entered here, I was stopped out, and then I re-entered, took my profits here. I did try to re-enter into a trade here, got stopped out, so I left that alone. Boom, we came back here. What happens? Here's buy side liquidity. What do? We run buy side liquidity into what? Oh my gosh, look at it. It's so nice. an order block, and a fair value gap. Wow, look at that. Boom. Now you see that price is too weak to even touch the order block in the fair value gap, right? So what ends up happening is it stays weak. And so now we want to identify if price is weak, what PD arrays are going to form. If we can get that nice breaker, which y'all already know I'm looking for, then we can really be off to the races. Okay. So boom, let's identify our breaker. We go to the 5-minute chart. We can identify a breaker within this mindset that we're going to be taking a trade that hopefully is above the 12 a.m. open of the Asian session, which I have here. 12 a.m. open on Thursday was right here. Price is trading above it. Okay, we're looking. We have more confluence. Okay, we ran out buy side liquidity. Boom, into a PD array. Doesn't even touch the PD array. You got fair value gap and an order block. Again, cool. Now, where's my breaker? I want to see where's my breaker. I want to see what's going to happen with my breaker. If I can have a breaker, then I can have a little bit more confluence. Boom. High, low, higher, high, lowest down close candle, breaker. You would say, well, you have 3 consecutive candles. Yes, I do. But the reason why I use the lowest down close candle on this one. Good morning, outsiders. What's good with you, bro? The reason why I put my lowest down close candle, use my lowest down close candle here is just because where my fair value gap was located. It's basically aligned below this lowest down close candle. And so when I enter, I'm trying to use the lowest down close candle, you know, of the breaker in conjunction with wherever that fair value gap zone is, right? And so this is the zone right here. Now, this is the 5-minute. I wonder, did I have a 15-minute? I must have had a 15-minute fair value gap. Yeah, let's look at that. Must have had a 15-minute fair value gap. Yes, and did I? This is Wednesday. I don't know. Oh, yes. Okay. So I had the 5-minute breaker that we just outlined, and we had the 15-minute fair value gap. Now, price obviously trades above my 15-minute fair value gap, and you can see I entered at basically within the 15-minute fair value gap. So if you go back down to the 5, keeping this in mind that I had a 15-minute fair value gap, right? Let's go. Oh, we're going too far to the right. Here we go. And if we can get back to where we were in price, I'm gonna stop changing the time frames because this thing be scrolling so slow. All right, so boom, you see that I got my 15-minute fair value gap, and I entered within the 15, right, basically here. Now this was probably too early of an entry. Probably should have waited until I saw price respond. Then I look, I entered here. I saw price respond to the 15-minute fair value gap and also the lowest down close candle. Now, had I just used the consecutive candles, then I could have then still kept in range, like, okay, I can have price go as high as this, right? And obviously you see it works out. But I was really trying to get a very precise entry. And so my stops were likely set above the breaker, and I probably looks like I didn't get ran out here, so I wonder where I set my. Oh, no, you know what? I believe I set my stops above the high of the day. So that's another confluence, right? Is okay, we have the breaker, we have the run on liquidity, right? Into what we had up here was the fair value gap in the order block, which price was too weak to touch, right? Now, what do we have? We know that we're potentially at the high of the day, understanding that we're still majorly bearish, and we're trying to take a move in the sell side direction to target that, ultimate weak sell side liquidity. But if you can get an entry here within this breaker and look at where is the high of the day, it's only 20 pips away. So instead of setting my stop for 7 pips above the breaker or potential breaker zone, I would set it way up here, which is only 20 pips, not way up there, it's just up there. I would set it up here above the high of the day so that even if my breaker zone is ran out, right? Even if this overall, if I had used all 3 of the down close candles, but I really just used the lowest down close candle, even if my breaker zone is ran out, I still won't be knocked out of the trade, and it's still a solid risk model, right? It's still a solid risk amount that, okay, if I lose it, It's not that much compared to what I could make. Now, as you see, price runs the stops that I had, runs potential stops that I could set here, but I had my stops up here, so I was safe. And then what does it do? It runs off. And it also forms another breaker. High, low, higher high, lowest down close candle here. You could have put your breaker right there, and you see the price came basically right back up, traded right back into it. And when you start to see these breakers form like this and consistency like this in the same direction, you start to see, your price, your targets are easily identifiable. Like that's when you know that the market is starting to even out. You're going to start getting a lot more trades, that are easy to peg down, easy to locate and actually execute on. A lot of times in the January, February, March timeframe, you're going to get like one of these a week. You're going to get, even in April, it can be a little choppy. You know, April into May, May into June, June into July, you see a lot of price evening out and giving you a lot more clear setup. So just keep that in mind as you're looking at seasonal tendencies and understanding that, ICT has talked about us being majorly bearish in general, in a general sense for May. And then, talking about September through October into November, you're usually in a more bullish mode of trading. You just keep those things in mind and understanding all the other months in between, your January to February, part of March, and then your July and August sometimes can be choppy. Even your December can be choppy, November, December. So just keep those in mind as you're trading so you know where you're at, right? So boom, I entered here, stops were above the daily high, using the same thought processes before, understanding that we're trying to enter above the 12 a.m. open. Boom, we get exactly what we want. And a low hanging fruit target is here. You got 30 pips from where I entered, about 30. If I just go from the low of that candle, this candle that I entered on, you got about 30 pips, right? So this is beautiful. I don't need any more than this. And that's why you see I took my trade out here at right about 39, right? I don't need any more than this, because when price came down here the first time, it went way back up into the range. So that can be a little bit scary for some people too, because if you're watching that live, you're like, okay, I got my stops to profit, but darn, I want my money. You know what I'm saying? So you have to be careful. But if you continue to trade with confidence, sometimes it'll turn out your way, sometimes it won't. But you shouldn't have any reaction towards that. As ICT likes to say, just continue to trade, understanding that if it's in your favor, it will pan out. So you see, I took my trade here, and then if we're looking at that overall target, right? We never got close to our weekly potential target. But what did we get close to? We got close to the fair value gap that was right in that same range that we outlined way over to the left. And I can show you now. We can go to it. We got close. We basically touched the top of that fair value gap way over to the left. Let's go to it. Oh, yep, there it goes, there it goes, there it goes, there it goes. Oh, shoot. Oh, shoot. Let's go back. Oh, my gosh, bro. This thing wilding. All right. Let's zoom out. Hey, tripping. Yeah, whenever I'm streaming, I need this thing to even out. But if we can get to the fair value gap in the freaking zone, then I can show you. We went all the way back to 2022. Good grief. All right. I think it's up here. All right. All right. All right, y'all. Excuse my computer. All right. All right. Let's go use the bathroom. Yeah, well, my daughter's up, y'all, so it's wraps. But let me just show you the fair value gap. Boom. Hourly. Oh, Lord. Is this the fair value gap? Uh-oh. Okay, let's go. Let's go use the bathroom. All right. Yeah, I don't even know where it was that I wanted to show y'all, but I gotta go. So go look earlier in the video and you'll see the fair value gap that I was talking about. But that's what I wanted to give y'all. I'm out. Daughter's up. See y'all later. All right. All right, let's go. Let's go. Let's go. Let's go. Come on. Come on. Come on. Come on.